thinking of selling your business, here's what you need to know before you exit. So if you're thinking of selling your business or even just wondering what the process might look like in the future, it's worth knowing that how your company is structured can make a huge difference to the outcome of a sale. A lot of business owners focus on growing the company, increasing the profit, building brand value, all of which is vital, but don't always stop to think about what actually happens when you exit. If you don't plan ahead, you could end up giving away more in tax than you need to. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor. I train at one of the big 4 firms in their private client team and now work with business owners and families on UK tax, exit strategies, inheritance tax planning, and long-term structuring. In this video, I'll walk you through the different ways that you can own a business, what the reliefs are available on sale, and what kind of planning you should be thinking about now, especially with the tax rules getting tighter in the coming years. So let's start with the basics. There are really 2 main ways that you can own a business. Either you own the trading company personally, you're the direct shareholder, or your shares are held by another company, typically a holding company that you're the shareholder of. The difference in ownership can completely change the way a sale is taxed. Let's start with personal ownership. If you own shares in a trading company personally and you sell those shares, you'll usually be subject to capital gains tax on the profit. That's the difference between what you sell the shares for and what you originally paid for them. Though in practice, many founders acquired their shares for a nominal amount because you probably set up the company for £100. Now, if the company qualifies and you meet certain conditions, you may be able to claim business asset disposal relief, or BADR. BADR means you pay a reduced rate of CGT on the first £1 million of qualifying gains over your lifetime. The CGT rate you pay if BADR applies is currently 14% on the first £1 million in gains, and then 24% thereafter. Now that 14% rate is rising to 18% from April 2026. If BADR doesn't apply, then most of your gain would be taxed at 24%. So what are the conditions for BADR? First, the company must be a trading company, not one that mainly holds investments or rental property. Second, you need to be an employee or officer of that company. And third, you must own at least 5% of the shares and voting rights. Crucially, you must have met these conditions for at least 2 years prior to the sale for BADR to apply, which makes planning ahead crucial. This might sound straightforward, but this is where people get caught out, especially if they want to involve, say, a spouse or partner in the business to use their BADR limit as well. Now, if your spouse only becomes a shareholder a few months before the sale, they're not going to qualify. You can't fix this retrospectively. So if there's even a chance that you might be selling in the next few years, it's worth sorting out the structuring now before any discussions with buyers even start. Now let's look at corporate ownership. Where your shares in the trading business are held by a holding company, it's the holding company that's going to be selling the shares, not you personally. And the tax treatment is completely different. If the conditions are met, then the gain could be completely exempt from corporation tax under the Substantial Shareholding Exemption. That means that if the holding company sells the business for, say, £5 million, the full £5 million can be received tax-free in the holding company. Now, that does mean that if you take the cash out of the holding company, you'd be paying tax. But if you'd be reinvesting this, for example, into property, then this could be much more tax efficient for you. The conditions for SSE are broadly that the holding company must have owned at least 10% of the trading company's shares for a continuous period of 12 months within the 6 years prior to disposal. And again, the company being sold must be a trading company. For business owners who aren't looking to take the full proceeds out straight away, this structure offers a lot of flexibility. You can defer the personal tax charge, reinvest the funds at the corporate level, or build a longer-term plan for drawing out the value tax efficiently. You could even look at a family investment company planning, alphabet shares, or even trusts, all of which will become more viable when you've got a big lump sum sitting in the corporate entity. But what if you want the cash personally? It's a common question. And well, the answer is it depends. If you own the company personally and sell it personally, the funds come to you immediately. You do pay the tax, but you get the benefit of having all of that cash available to use. If you sell it through a holding company and you want access to the funds, you'll then be taxed as you take the money out through dividends or salary. So it's not always about paying less tax. It's about controlling when the tax is triggered and seeing what's best for you and your circumstances. And if you don't need the full proceeds personally, and say you want to reinvest, or support family, or do some legacy planning, having the cash in a holding company gives you more options to work with. Whether you're selling as an individual or through a company, there's a few other things to bear in mind. First is due diligence. Any serious buyer will want to review your accounts, legal agreements, and tax position. If there are any gaps, unpaid tax, missing filings, or tangled loans, it could delay or even kill a deal. So as part of preparing for a sale, make sure your books are in order. Get your documents ready and fix any known issues, and make sure you understand your numbers. Second, structure of the company. If your trading company owns investment properties or unrelated assets, this can create problems for the BADR position and make the business less attractive to buyers as well. In some cases, You might want to move these assets out through a demerger, for example, before the sale. Having a group structure makes this a lot easier. You can transfer assets between companies in the same group without triggering tax charges. But again, sorting this out ahead of time is key. Don't try to move out assets the week before sale. This will just raise red flags. And finally, post-sale planning. If you receive the proceeds personally, you'll likely have a much larger estate for inheritance tax purposes. If the money stays in a company, you might be able to do some planning around trusts, gifts, or growth shares to mitigate that tax exposure. A big business exit is often followed by a wider plan as to what happens next. What do we do with this money? So it's worth thinking about that ahead of time as part of these conversations about sale. Selling your business isn't as simple as just finding the buyer and agreeing a sales price and moving on. It's about making sure that you've structured in the right way to keep as much of the value in your hands as possible and out of HMRCs. The earlier you start planning, the more options you have. That might mean bringing in a spouse to qualify for BADR. It might mean restructuring to use a holding company and claim SSE, or it might just mean getting your paperwork in order and cleaning up your balance sheet. We work with clients like this all the time, from early stage planning to deal execution, helping them protect the value that they've spent years building and out of HMRC's hands. If you're thinking about selling or even just want to get prepared, feel free to reach out. If you like this video, then drop it a like and hit subscribe. It helps the channel more than you know. As always, if you have any questions, comments, or any topics that you want me to talk about next, drop them in the comment section below. That's it for this video. Thanks for watching.